Right now, in an account you check almost every single day, your money may be quietly losing value. Not because you spent it, not because the market crashed, because it's sitting in the wrong place. A huge number of young adults have never seriously questioned whether their bank account is actually working for them. They open an app, they see a number, and they assume that number is safe, but its purchasing power may be falling because the interest you're earning is often lower than inflation. By the end of this video, you're going to understand exactly which accounts you need, which ones are quietly holding you back, and how to rebuild your entire financial foundation in under 30 minutes. Stay until the end, because one of the accounts on this list is one almost nobody sets up in their 20s, and it can end up separating people who retire comfortably from people who work well into their 60s or 70s. Let's start with the account you're probably using wrong right now. Here's a number that should make you uncomfortable. Many traditional big bank savings accounts pay very little interest compared with what you can earn elsewhere. Meanwhile, inflation has been running well above that. That means every single year, without doing anything wrong, without spending a dime, the money sitting in that safe savings account can lose purchasing power compared to 12 months ago. Think about that for a second. You worked for that money, you skipped the takeout order, you picked up an extra shift, you said no to a trip with your friends so you could put $200 away, and the interest rate on that account may not be reflecting that discipline back to you. This is the part nobody tells you when you're growing up. We're taught to save. Nobody teaches us where. Here's the honest explanation for why this gap exists. A traditional bank's business model doesn't necessarily require it to give you the highest possible interest rate on your savings. Banks use deposits to fund lending and other business activities, and paying you a higher rate cuts into that margin. So if that's the problem, what's the fix? It's called a high yield savings account. And the interest rate compared to a traditional bank can be several times higher. Let's put a real number on that. $10,000 sitting at a low rate like 0.1% earns you about $10 a year. That same $10,000 in an account paying around 4% earns roughly $400 a year. That's a difference of almost $400 annually on the same amount of money doing the exact same job. Stretch that gap out over several years, or apply it to a larger balance, and it can genuinely cost you thousands over time. It doesn't expose your emergency fund to stock market volatility, and if you choose an FDIC insured bank, your eligible deposits receive the same federal deposit insurance protection you already have today. But before you go set one up, I need you to understand something, because this is where most people mess it up. Quick question. If you could get a meaningfully better return on essentially the same product, same protection, just by switching where you keep it, would you still say no just because it's inconvenient? Because that's what a lot of people are doing every day. They leave money sitting in an account paying almost nothing. The mistake isn't just picking the wrong bank. The mistake is thinking one account is supposed to do everything. You have one account for spending, saving, and sometimes even investing, and you're wondering why nothing ever grows. That's like trying to use a single tool for cooking, cleaning, and fixing your car. Each job needs the right tool. Money is no different. Let's rebuild this properly, piece by piece, starting with the foundation. The first account is your checking account. This is your operating account. Rent, groceries, subscriptions, gas, nothing more. The moment you start treating your checking account as a savings account, you lose track of your real spending, and you make it nearly impossible to tell if you're actually building wealth or just floating month to month. The second account is your high yield savings account, and this is where your emergency fund lives. 3 to 6 months of essential expenses sitting there, earning real interest, protected by FDIC insurance if the bank is FDIC insured. This is not for vacations. This is not for a new phone. This is the account that exists so that when life throws something at you, a job loss, a medical bill, a broken transmission, you're not reaching for a credit card at 20-something% interest. This single account can be the difference between a bad month and a financial crisis. Now, here's where it gets interesting, because this is the part a lot of people skip entirely. The third account is a retirement account, specifically a Roth IRA if you're eligible for one based on your income. And I want you to really sit with this, because it might be one of the most important parts of this entire video. One quick clarification before we go further, because this trips a lot of people up. A Roth IRA isn't an investment itself. It's a tax-advantaged account that holds your investments, things like stocks, ETFs, or mutual funds. The account is the container. What you put inside it is what actually grows. If you're in your 20s, time is one of the greatest assets you have, because a dollar invested at 22 has decades to compound. That same dollar invested at 42 has half the runway. With a Roth IRA, you contribute money you've already paid taxes on, and qualified withdrawals in retirement can be completely tax-free, including the investment growth. Contribution and income limits can change, so it's worth checking the current numbers before you open one. A lot of people your age either don't know this account exists or assume retirement accounts are for people who already have money figured out. That assumption alone can end up costing the average person a significant amount of money over a lifetime. Let that sink in for a second. Not from working harder, not from a lucky break, just from opening one account a lot of people your age have never even heard of. And there's a fourth account that many people don't think about until much later. One that most people in their 20s assume they don't need yet. I'm going to get to exactly what it is and why waiting until you're older to open it might already be costing you something you don't even realize you're losing. But first, you need to understand how these accounts typically get prioritized, because thinking this through can be almost as valuable as opening the accounts themselves. Here's the uncomfortable part. A lot of people who do everything right, checking account, savings account, even a retirement account, still end up financially exposed because of one account they never opened. I'll show you exactly what it is in a moment. But first, let's talk about how to prioritize, because this is where discipline actually turns into wealth. Keep in mind, everyone's situation is different. If you're carrying high interest debt, or your specific employer or health plan changes the math, your order might look different from this one. But for a lot of people starting out, this is a reasonable place to begin. A common starting point is building an emergency fund in that high yield savings account, while also making sure you aren't leaving an employer match on the table. If your employer offers a retirement match, it's one of the most valuable benefits many employers offer. Essentially, compensation you're entitled to if you meet the plan's requirements. From there, a lot of people work toward consistently funding that Roth IRA. Even $50 a week, started now, compounding for the next 30 or 40 years, can turn into a significant number by the time you retire. This is not about being rich, this is about being free. And now, the fourth account, the one a lot of people don't set up in their 20s, a health savings account. If you're eligible for one through a qualifying high deductible health plan, this account can offer a set of tax advantages that are hard to find anywhere else in the financial system. When used for qualified medical expenses, you can potentially benefit from a tax advantage on your contributions, tax-free growth while the money is invested, and tax-free withdrawals when you use it. And here's what a lot of people don't realize. You don't have to spend it on healthcare right away. It can sit and grow for decades, quietly becoming one of the most powerful long-term accounts you own, because eventually, most people have medical expenses, and this account lets you plan for them with real tax advantages built in. 4 accounts: checking to operate, high yield savings to protect, a Roth IRA to grow, an HSA to shield if you're eligible for one. That's the entire foundation, not 10 accounts, not some complicated system with spreadsheets and 12 sub-accounts. 4 accounts, each with one clear job, working together instead of one account trying and failing to do everything at once. Here's the part that should genuinely excite you. This isn't only about having a massive salary, it's about direction. Someone earning a modest income who sets this system up in their 20s can end up with more real wealth at retirement than someone earning 6 figures who never touches a single one of these accounts. The account matters as much as the income, because the account determines whether your money works while you sleep or just sits there losing value while you're not looking. So here's your action step, and I want you to actually do this today, not after you finish scrolling. Look into opening a high yield savings account this week. Move your emergency fund into it. If you have access to an employer match, confirm you're capturing it. And if you don't have a Roth IRA yet, that's the very next move worth researching, because the version of you 5 years from now is either going to thank you for the time you spent today or wish you'd started sooner. If this video showed you where your money should be living, the next question is how you actually build that first cushion of savings when you're starting from zero. I made a video walking through exactly how I saved my first $10,000 on a $65,000 salary. Step by step, no shortcuts, no gimmicks. Click on it now, because that video picks up exactly where this one leaves off, and it might be the push you need to finally get started.